Dainard. Gotta get this going. Is it on? All right. Is the screen already shared?
Yeah, you're doing good.
Good to go?
Mm-hmm.
What is going on, guys? We're going to get going on that June market update in just a second. We're going to let people log on for another minute, and then we will get started. Yes, we're active flippers. We also build. All right, guys. So we're going to get going on the June market update for the Pacific Northwest. Again, you guys, this will be a pretty quick presentation, 30 minutes, and then we will open it up for questions till the questions are answered. And we will get on with our day. So we're going to dig in right now. Sorry, guys. I'm trying to make sure I'm doing this right. Okay. So we're going to jump in right now. So what happened in June? We definitely have seen some different things going on over the past 90 days in our local Pacific Northwest market. So before we dig in, though, just a recap of who I am for all those that are new on the market update. My name is James Dainard. I've been an active real estate investor with my partner, Will Heaton, since 2006 or actually started at the end of 2005. So roughly we've been investors for about 20 years in the Pacific Northwest. We're known as the recession flippers and investors. We were buying and selling properties throughout 2008 to 2012. And we have a vast experience in value add construction. We've been involved in over 2,000 flips. And our brokerage, Heaton, Dainard Real Estate and Intrust Funding, we specialize in services for investors on sourcing on and off market properties and providing them with the financing to get these properties kind of stabilized up. So if you're looking for a hard money loan, definitely check out Intrust Funding. Since getting in the business, we've done over 3,500 transactions with investors just like yourselves. And so we are a very active brokerage shop that knows how to service investor clients. So let's get into what's going on in the market right now, because we are trying to keep our pulse on it. The good news is the tri-counties are doing a lot better, and we're going to go over that a little bit more. We've kind of hit this kind of stabilization period for a minute. We'll see what happens from there. But what we're covering today is we're going to be covering the tri-county review, King, Snohomish, and Pierce County. We're going to cover interest rates, inflations, and the jobs report. So we're going to look at what's going on with those tri-counties, and then what's going on with the outside effects of the interest rates and what that's going to do to us on an investment standpoint. So right now, generally for Washington State, Intrust Funding does provide financing for investors throughout Washington. Home prices right now, year to date, are down 1.9% in June, which makes a lot more sense right now. So we're seeing that the median home prices are kind of starting to cool on the dipping. When rates started getting hiked last April pretty aggressively, we really saw the market stall out and go into a mini panic in July and June. And in August. And so I think what we're going to see over the next 90 days is we're going to see that the big drops that we've been seeing of like 7-8% really get shrunk down to about 1 to 2% on the high end, because we saw these huge drops. And right now in our market, we're seeing things sell for a little bit more than they were selling for 6 months ago. It seems like people are getting more comfortable with the rates and they're absorbing properties because there isn't a whole lot for sale. Median home price right now is at 621 in Washington, and the average days on market, and this is a big stat, is at 7 days. About 6 months ago, that was over 30 days. So properties are selling quickly again. Year over year supply, not a whole lot of stuff in the market. We are down 22% for homes for sale right now. So again, the amount of product in the market, we are already under really dangerously low housing supply inventory, and now we're down 22% year over year. Number of homes sold are dropped by 28.1%. That's because there's just not a lot of homes for sale right now. We are seeing more buyers coming through properties, but the amount of product that's there is not a whole lot. So King County, the three big stats that we're looking at is what's the general trend. So the median home price is down 2.4% to 830,000. Now, I think the median home price at the end of December was in the 700s, in the high 700s. So we are seeing the median home price kind of pull back up. Um, One thing I do want to kind of put out there is because there's a lack of data right now and a lack of sales, this median home price is fluctuating a lot more month by month, on percentages up or down, because of just the lack of sales and activity. And what we're seeing right now is the homes that are selling are in usually fairly good shape, and they are on the higher end of the pricing. And so that's kind of dragging the median home price up a little bit still. Um, but right now it's down 2.4%. Roughly, it was down about 7 to 8% towards the beginning of the year. So we are seeing that kind of starting to come down. I actually anticipate that we might see King County be up a little bit in August and September, just because those drops were so drastic throughout August. When the rates went kind of shot up, King County was the most affected, in the first, I would say, 6 months from June to October, November. It's because it's more expensive market. The buyers are a little bit more savvy. They like to take their time, and we saw that market compressed the quickest. Areas like Snohomish County, Bothell, Shoreline, all those areas compressed really hard, and we're seeing those start to climb back up and sell for more today. Median days on market is at 7, down from 42 in January. And that's a huge trend for people to be watching right now, because we're seeing things get absorbed. Things are selling quicker. There's not enough stuff in the market, and there is buyers on the sidelines. And so, if you're putting out a good product that's priced well, it is selling very quickly. I think the last 2 flips I listed myself personally, we sold in the first 3 days. So again, things are moving very, very fast. The upper echelon pricing right now, the 2.5 to 3.5 range, or even higher, that is still taking quite a bit longer to sell, and you got to be patient. I have a couple properties myself right now that are sitting, and they're just in the more expensive price range, but they're priced right, and so I got to wait. Number of homes sold was at 2,438, and that's down 25%. Again, you guys, transactions are just really low right now, especially in King County. You're hearing that from lenders, title officers, brokers. And it's because there's not a whole lot for sale. Buyers are being picky, but what we are seeing is there is still more buyer demand than a product for sale. So that's a good thing for investors as you're going in for your dispo. Pierce County median home price is at 545,000. That's down 3.6%. That makes sense that it's down a little bit further than King County, because Pierce County was trailing behind King County a little bit throughout this interest rate adjustment. And we've seen that trend nationwide as well. More affordable markets did not come down as quick. As you know, since the pandemic, people have gotten used to moving outside metro areas. They're expanding out. And so that's kind of keeping a lot of these more affordable areas with the higher price points. Average median days on market is at 7 days. That's up 1 day from year over year. And again, you'll see that start to trend the other way as well, because Tacoma or Pierce County's market kind of trailed behind King. So their days on market didn't shoot up until the 20 and 30s until about August. So we should see days on market drop pretty drastically year over year over the next 60 days. Number of homes sold was down 34%. So again, not a lot of stuff in the market, not a lot of things to buy, and things are still trading very quickly. Snohomish County median home price is at 745,000. That is down just under 1% year over year. And again, that doesn't surprise me for a second, because Snohomish County dropped drastically in that first 90 days of interest rate hikes. It compressed really, really quickly. I had a house in Bothell, Washington, and it went from a value of 1.2 to 1.25 down to $1,025,000 very, very quickly. Now we've seen that property actually climb back up in value to around a 1.1 to 1.15. And so it had a little bit of an overcorrection, and it's starting to pop back up. So we started seeing it fall in June and July. I actually think that the median home price could be up again in August, just because of how much compression we saw in Snohomish County. Median average home days on market are at 6 days. That is flat year over year. So things are still transacting very, very quickly. Remember, guys, it takes on average 3 to 4 months to sell a home over the history of typically over the last 50, 60 years. It takes roughly 30 days to sell a house. we're still below that drastically, and that's because there's a lack of supply. So rates are definitely up, affordability is down, but the lack of inventory is still moving things fairly quickly. Number of homes sold was at 884, down 34%. So again, not a lot of transactions going on. So if you have a good product, get it to market, price it right, it will sell. Heaton Dainard, we sell a lot of new construction, a lot of highly stabilized properties on the upper echelons of the price point. So typically, we're taking these properties to highest and best use. A ton of capital, ton of money is getting put into these properties, and so when they're sold, they're always priced on the higher end. So the remodeled flip product and new construction is taking a little bit longer. On average, right now, we're still getting about 3 to 4 showings a week. If we're in some of the sweet spot price points, let's say we're 6 to 700,000 in Seattle, we're usually getting about 4 to 8 showings a week. So that has jumped up pretty drastically. Or if we're in the east side and we're in the million to million three range, that has jumped up to about 6 to 8 showings a week as well. So, depending on where the affordability is in your local market of where you're going to be selling your property or which property areas that you're looking to invest in, that's going to really dictate the amount of showings, and it really comes down to that affordability. So our average is about 3 to 4, but depending on the price point and the location, I would say, for the more expensive properties, 3 to 4. For properties that are in the more affordable price range, we're actually getting around 4 to 6 on average, sometimes up to 8. Right now, we are 65% pending. Now, that is a little bit skewed because some of the stuff is up for pre-sale, which just takes a lot longer in today's market. If you are selling a property, new construction, and it's for pre-sale, it does take a little bit longer to get that buyer contracted. Buyers are really just trying to lock a property down, and they want to move in fairly quickly. And so the pre-sale market's been taking a little bit longer. But right now we're running about 65% pending. Our average days on market right now is trending at 27 days. So quite a bit higher than the local market. But again, that's because some of our products up for pre-sale or on the upper echelon of pricing where, I think our average list price is around 1.5 million right now. Our product that is in that $3 to $4 million range is getting it's taking longer than that. We're really around 90 to 120 days on that product. And right now we're trending around 96 to 90%, 98% of list price. So overall, things are getting absorbed. People are getting their property sold, and things are moving. All right. So now that we kind of covered the Tri County, and you guys, if you have any questions, by all means, feel free to reach out or send me a message on social media. We will try to get answers back to you about the current markets. One thing that we might be adding into on the next market updates, I might add in Skagit and just Eastern Washington into the data so we can get a little bit more information out across into Western Washington for you. So now that we covered the housing market, let's talk about the economy, interest rates, and inflation, because that is really going to dictate what the Fed does, which is really going to affect affordability. If as inflation starts to cool, they should slow down on interest rate hikes, which they have done. But there's some other factors in there that could cause interest rates to still rise with the labor market. So first things first, let's talk about inflation. That's been on the top of everyone's head the last 18 months. And because we saw just a drastic increase in that. What we are seeing is pricing is settling down and inflation is slowly getting under control. Some items still feel very inflationary right now, where, especially as investors, we're out buying different types of material, pricing still swinging everywhere. But what we've been able to achieve is by calling numerous vendors, calling and pricing and pricing and pricing, we're getting able to get our prices back down to where they kind of were. So if you're struggling to get some products for the pricing you're looking for, just make 4 more phone calls. That will work. So in June, prices rose just 0.2% from May to June, thanks to easing costs on gasoline, airline fares, used cars, groceries, and inflation is just up 3% over the last 12 months. So we are seeing it cool down from where it was at. If we looked at, I think it peaked around like 7-8%. And so, we are seeing that cool down. That is good sign. Things should get a little bit more stable. The thing we need to watch out for is what is the labor market and job wages going to keep doing to these costs. The 2023 forecast, the National Institute of Economic and Social Research has forecasted inflation to be more persistent. It predicts that inflation in 2024 will be will be around 4 to 5%, and only around 1.8 to 2% in 2025. So that's a good trend, right? Things are starting to get pulled back. That should get the interest rates a little bit more stable. So all good predictions. I have seen inflation cooling. I know our construction costs are kind of falling right now as well. Um, Economic indicators. So right now, the June overview. So the U.S. labor market cooled off in June by adding 209,000 jobs. But you guys, this is something. Don't just pay attention to inflation. You want to really be looking at the job market, the U.S. market, the U.S. labor market, because if the labor market doesn't cool and there's still high demand for jobs, it's going to keep pulling the labor market up, which is going to add more inflation. And the Federal Reserve is probably going to increase rates higher. They want to really cool down this labor market. And so this is something that you really want to watch. I see everybody kind of goes to inflation. That's a good thing to check for, but also be really concerned about what's going on in the job market. Unemployment rate changed little at 3.6%. So even with all these interest rate hikes and trying to slow down this economy, the unemployment's still not moving that much. And then right now, the latest data shows that we have over 9.8 million job openings in the US, but only 5.9 million unemployed workers. And so again, there's a higher demand for workers than there are than the demand for workers is substantially higher. And that could cause more wage growth, which could cause more issues in general, because that's going to cause more inflationary items. It's going to they really got to cool that down. And so if that keeps growing, and that the gap between unemployed and job postings doesn't kind of close a little bit, we could see rates continue to rise. So current rates, we are not at the peak of interest rate hike cycle, but we're getting closer to it. So the Fed has obviously been very, very aggressive stepping on rates this last 12 to 15 months. Um, the good news is we're kind of through the thick of it with these huge rate hikes, but that we are not done. We're anticipating another quarter point hike at this next Fed meeting. The Federal Reserve will likely raise to 5.25 to 5.5. So at the end of 2023, some policymakers are now starting to kind of switch their tune a little bit. They were predicting at the beginning of the year that we'd be in kind of the high mid fours. Now they're kind of predicting that they're going to stay stable at the 5.6. So that means there's a little bit more growth than where it's at today. And so the one good thing about that is if it does stay stable, we can really see what the impact is. And we can kind of predict better as investors. But definitely something to keep your eyes on, and not great news because we were thinking it was going to be in the high fours by the end of 2023, or that's what they were predicting. Now, Realtor.com is still predicting that the average interest rate is going to be 6.1 by the end of the year. So they would technically think that the Fed rate is going to be going down a little bit. So if Realtor.com is right and it goes to 6.1 by the end of the year, we could actually see some more appreciation growth. As the rate falls, the housing market's going to improve. And so, really keep your eye on those interest rates and what's going on with those predictions. They are all over the place. Very, very smart people are predicting that they're going to be higher. Some are predicting that they're going to be lower. As an investor, interpret what people are saying, do the research, talk to, listen to podcasts, listen to On the Market podcast, the Bigger Pockets. We discuss all these items, and then you got to figure out what you really believe. Because if you think rates are going to be lower by the end of the year, you should be buying now. If you think they're going to be stable, then buy a little bit deeper and make sure you have that padding in there just in case there's any kind of issues. But if you do think rates are going to go down, which I do think they're going to have a little bit of relief, I'm looking at buying rentals now because that's going to naturally pull up my margins. So current rates on a 30-year fixed, we're at 7.23. A 20-year fixed rate, we're at 7.25. That doesn't make any sense. A 15-year fixed rate is at 6.4, and a 10-year is at 6.68. That's a little weird. The 10 and the 15 are swapped out too. 5/1 ARM is 6.19. A 10-year 10/1 ARM is 7.37. And then go on from there. So you guys, as your investors, make sure you're constantly checking rates. I got a couple of properties I'm buying right now. I'm calling my lender today, or calling numerous lenders today, because you really need to know what your cost of money is. There is some very good buys in the market right now to hold on to, but you got to have the right debt set up. Um, in the impacts from these rate increases in what it's done to us for investors is it's done a couple core things. The first thing is it's got longer market times. When you're selling your dispos, development, any kind of rental property on 1031 exchange, fix and flip properties, you need to anticipate to hold those things for an additional 30, 60 days just in case. There has been an affordability crunch. So as you're targeting your flip properties or properties for dispo, look at where the transactions are moving. That's telling you where the sweet spot is and what people can afford. A lot of this product would sell. It's just there's not enough buyers in the market that can qualify for that kind of high of a payment. So really look at where the fluidity is in the market, where things are transacting, and then go for the affordable pockets. Buyers are still being selective, but they are pulling the trigger on properties that are good, and we are seeing steady showings, not a surge of showings, but we are seeing steady showings throughout since rates have kind of stabilized out. So what are we doing internally? We are underwriting and just increasing our hold times. We're adding an additional 30 days to all of our holds. We're still putting in our 5 to 10% construction contingencies just to pad the deal a little bit more. Even though construction's starting to soften on costs, we're still adding that in just as a buffer for profit. Using cluster comps, properties that are close. We are going back as reference points is because one of the issues is there's a very lack of data in the market right now. So we're the first set of comps we pull are very tight, and then we go within a 5 to 6 month back on the timelines. And if we're not finding good data from there, then we adjust it to 6 months at that time or 12 months. We feel like we can go back in time right now, 12 months, because the market was actually worse from July to October. Right now, we're a little bit more stable and it's bounced up. So those are we instead of going out on our comparables, we're actually going back a little bit because we feel like the market was a little weaker back then. We have increased our average returns from 16 to 20% on cash, or from we have increased our returns anywhere between 16 and 20% on a cash basis, which is going to get us about a 35 to 50% cash on cash return with leverage in there. And then we're focused on larger margin deals. There's a lot of good buys out there right now on product that needs a lot of value add. If it's hard to renovate, people are staying clear from it, which is giving you a much wider margin and a much more protected investment. It just comes with a little bit of hair on the construction. So trends that we are seeing, average hard money rates, hard money has really, um, on average is 10 to 12%. And if you want that 10 to 11% money, there's a lot that comes with it. Lenders are being a lot more cautious than they were 12 months ago when they were sending money out the door left and right. They want to make sure they're really digging in the asset. They're using appraisals. They're really checking the as is value as much. And so what that's doing is it's making a lot of lenders require their down payments are higher. And so as you're working with lenders, really find out what you need. For us, we use interest funding because I'm a little biased, but they're fast, they're quick, they get their construction draw out to you immediately. As you're paying a higher rate and you're doing construction loans, you want to see what's that draw process, right? Because if you're paying a higher rate and that gets delayed by 2 weeks because of the process, or even 4 weeks over the duration of your time, that's going to cost you $4,000 to $6,000, or maybe it's going to cost you rates to leave 1 point of your balance. And so, make sure that you're working with lenders that can get you in and out of deals. Other trends we're seeing is DCR coverage is important to lenders. Private banks or local banks, they really want to see that the asset can pay for itself, and they want a higher debt coverage ratio. And so, as you're looking at properties, again, make sure you're taking your income, run it by your lenders, getting approved, and then you can really figure out how much liquidity you're gonna have to leave in it. I recently was told I needed to bring in more cash to get a deal closed because of DCR coverage, even though I was buying it about 300 grand below market. And so what I had to do is work it out with the lender, bring him in some deposits, and then we got our down payment up or reduced. And so things like that will go a long ways, but really talk to your banks, figure out where they're lending at and what they need from you to get that loan done. Banks are requiring larger down payments right now, hard money and kind of conventional lenders, traditional lenders for investors, like on your 5 units and above commercial, they want larger downs right now. So if you want to leave less cash in the deal, you got to go for heavy value add. Less cosmetic opportunities to purchase right now. You guys, because there's so little inventory, right? Sales are down drastically because there's nothing for sale. Owner occupies are outbidding investors a lot on cleaner properties, and the margins are a lot tighter on those deals. So there's a lot less competition or a lot less product available for cosmetic. And at the same time, it makes the margins thinner and thinner. If you want an easier project in today's market, you just got to be okay with a little bit lower return. Construction costs have compressed down about 10%. So we have seen savings across the board. We've seen it in we now are flipping, but it does take negotiation and education of your subs. Just talk to them, price them out, and just keep getting quotes. I recently had a landscaping quote on a property, and we got 4 quotes. The first three they came in like 5, 7, and 9. The fourth quote came in at $1,900. And so just keep pricing things out. There is guys out there to work. You don't need to pay these outrageous labor costs on some of these items. Investment trends. So what are we seeing in the market and what is the good buys? Again, we're recession flippers. We buy in any type of market. We just go where we just go where the opportunities are. So we are seeing the highest returns on large discount heavy value add properties. For example, here's a property we just sold this month. Where we got the client the deal for 970,000. They're putting 300,000 into the fix up, doing a massive reno, and then the values, and this is in a great neighborhood of Seattle, is at 1.75. So he's got over almost a $500,000 in spread there to offset his debt costs, his sell costs, and his profit in there. There's a lot of margin. This property could sell for roughly 10% less, and it's still gonna break even. So if you're nervous about the market, these large projects have the spreads in them and they have the profit. Buy those. If the market continues to shift, you still should be okay. And if not, your cash on cash returns are going to be through the roof compared to what you'll see on the cosmetics. Dirt prices are still down about 20-30% off peak. So there is opportunities out there. A lot of good buys on single family rental properties, on RSL lots, or different development upside properties. Developers have slowed down what they're buying or the speed that they're buying in. So many sellers are more open to a quicker close and a lower price, which can allow you to buy this rental property and keep it for a long-term hold. Dadu flip projects, the combination of a flip and a Dadu project where you're flipping the house in the front and building a Dadu in the back, they have higher returns as well. Just like the larger value add properties, they come with a lot of work. You got to, renovate a house, you got to build a house in the back, but the spreads are huge right now. And we're seeing average returns of around 50 to 60% on those types of deals. In addition to, it can give you a versatile investment to where you would keep one for some reason. If the market starts spiking, you decide to keep it, then you can, it allows you to sell one, get your cash back out, and then really keep a rental property with very little money out of pocket. Average days on market, we've talked about this, are selling dramatically quicker. So other investment trends is things are just moving, things are going well. We're able to get good buys on property. The amount of volume's down, but the properties that we are getting have good returns and substantial discounts. So now what we're going to do now, you guys, is we're going to open it up for questions. For more free education, definitely go check out the Bigger Pockets podcast on the market, or Bigger Pockets in general. We're constantly covering different types of economic updates in there and what to forecast into your performa. For more information, make sure you definitely check out Heaton Dainard on social media, or Jane Dayton Flips myself, and Intrust Funding. And we will get you more information. Oh, and then for more education, go to jamesdainard.com, where you're watching this broadcast right now. So we're going to open it up for questions right now. And so if you guys have any questions, just put it in the chat box. And if I don't get them quickly, we will log off because I got some sales meetings to do. All right. Well, if I don't have any questions, all right, guys. So if you have any questions, put them in the chat overlay. If not, we are going to get going. Um, One other thing, guys, right now that I am noticing kind of in the market is, sellers are, um, sorry, we're having a little bit of technical issues. Sellers are being a lot more flexible when you're working with off market too. So when you're talking to people, just if people are trying to get a higher price, go look at the terms, look at the overall structure. We've been able to get some deals done just by kind of listening to what the sellers need, and get them the right terms, and allows us to kind of reduce some costs, get them some more money, or give them more time. So all these things will help you transact as well. And also for anybody that wants to get more involved at Heaton Dainard, definitely come to our investor one-on-one meeting. We are doing a change in format. The new one-on-one will be out next month, where we're going to be talking about all sorts of different types of investments outside fix and flip and buy and hold. So since we are quiet today with not a whole lot of questions, we're going to end this presentation, and I will see you guys next month.